Hi there, Stan the Annuity Man, America's annuity agent, licensed in all 50 states and Puerto Rico. Today's topic is annuities and taxes. The IRS lives in most people's heads rent-free. My hope is that's not going to happen in Chapter 2 of your life. A lot of people get obsessed with brackets and things like that and Roth conversions and all that. Just go live your life, okay? Just go live your life. We're going to talk about annuities and taxes and some details that you need to know after this. So annuities and taxes, interesting enough, one of the main points you might want to share at the next cocktail party, life insurance companies issue annuities. Life insurance, the death benefit is tax-free to your beneficiaries, but they issue annuities and those death benefits are not tax-free. So life insurance that you have to get underwritten for, etc., death benefits tax-free, probate-free, lump sum. Annuities issued by life insurance companies are not tax-free. So those death benefits are taxable. Now, there's many types of annuities. When you're taking annuity money out of an annuity, regardless of the type, SPIAs, DIAs, QLACs, income riders, index annuities, RILAs, variables, MYGAs, I think those are kind of the primary 8 annuities. That income is taxed at ordinary income levels. Now, that's a broad brush at it, so let's go a little bit more in detail product by product. Let's do MYGAs first. Multi-year guarantee annuities, the annuity industry version of a CD. The cool part about MYGAs, and by the way, all annuities types can be used in all account types. Roth IRAs, traditional IRAs, non-IRA, non-qualified. The only exception is qualified longevity annuity contracts, which can only be used in traditional IRA type accounts. But multi-year guarantee annuities, once again, can be used in all account types. It's a contractual interest rate for a specific period of time, just like a CD. Now, with non-IRA money, checking account type money, that interest grows and compounds tax deferred. Okay, so if you do pull money out, it's taxed at ordinary income levels, but literally, you can kick the can down the road forever. Someone asked me the other day, and I don't talk about myself too much, but he said, Stan, what do you do? I said, first of all, I don't do market stuff because I came from Morgan Stanley, Dean Witter, Payne, Weber, UBS. I found the best growth stock in the country. That's my company. But for my safe money, I do MYGAs because I don't need the income. I don't need to pay taxes on the interest. It's non-qualified money. There's lots in it, lots of MYGAs for big numbers, and it's just growing and compounding tax deferred. So guess who gets to deal with that down the road if I never take the money out? My daughters, my 29 and 27-year-old daughters, and guess what? They'll be okay. They've done pretty well. They've lived under the umbrella of capitalism that I've provided so well for these past almost 30 years. One's 29, one's 27 at the time of this taping, but the good news for you is you can have a guaranteed interest rate, typically better than a CD, and it's going to grow and compound tax deferred in non-IRA accounts. Obviously, you can put it in an IRA or Roth IRA, etc. Let's talk about Roth IRAs real quick. When it comes to annuities and taxes, if you put a lifetime income stream product in a Roth IRA, that income stream is going to be tax-free unless they change the rules. Same thing with multi-year guarantee annuity interest rate. Going to be tax-free unless they change the rules. So all of these things with the Roth, I personally don't have a Roth IRA. I don't trust the government, maybe like you do. I'm not against them at all. A lot of our clients do Roth IRAs. We don't recommend them because I don't trust the government to change the rules. I think they're going to change the rules. They're going to means test it. My hope for you is that you're grandfathered in and that doesn't change. So any of these products inside of an IRA, traditional IRA, when you take the money out, it's taxed at ordinary income levels. Roth IRA, it's not taxed right now unless they change the rules. But let's focus a little bit more on the non-IRA, the non-qualified, as they say in the business. In the South, we just call it checking account money, okay? What happens with these annuities and checking account money? All right, with immediate annuities and deferred income annuities, the lifetime income stream is a combination of return of principal plus interest, so you're only paying taxes on the interest. In our business, they call it the exclusion ratio. What that means in Stanglish is that Return of principal is not taxed. Interest is taxed. So one of it's excluded from taxes, the principal part. So single premium immediate annuities and deferred income annuities, which is in essence single premium immediate annuities that you defer past 1 year, same product, same structure, no market attachments, no annual fees, no moving parts, just a straight pension that you can start as soon as 30 days with an immediate annuity and as far out as 40 years with a deferred income annuity. There's some tax benefits because only the interest portion in a non-qualified account is being taxed. Now, income riders, which are also lifetime income products, typically attached to either variable annuities, RILAs, or indexed annuities. And historically, indexed annuities, when you attach them to those, the income rider guarantee is the highest. Just quickly, draw a line down a blank sheet of paper. Indexed annuity over here, we don't care about that. Bad CD product. Income rider contractual guarantee over here, that's what we're quoting for. That's not an annuitized product. That's what's called a drawdown product, meaning that you can shut it on and off like a light switch, even though it's lifetime income guarantee, but it's coming out at ordinary income levels. But it's pretty interesting though, with all of these products, when, let's go back to the immediate annuity, deferred income annuity. Let's say you live forever and you draw the account down to zero, the annuity company's still on the hook to pay. At that point in time, there's no exclusion ratio. You got to pay taxes on the entire amount because you're now in the annuity company's pockets. Same thing happens with income riders. There could come a time where you draw it all down to zero and outlive their projected life expectancy. You're in their pocket, so all of it's taxable at that point in time. But with income riders and a non-IRA account, the interesting part is there is a point in time that you're into the principal part. You wrote a check for it, non-qualified, non-IRA, checking account money. You had an income rider attached to it. You drew it down to get to the principal of that index side. That's not taxable because it's principal, and I'm assuming the index annuity is not going to return anything. And then when you get to zero, then it's all taxable. We'll explain all of that to you. But there are some, when it comes to annuities and taxes, obviously there's not, people say, well, I'm just going to put everything in an immediate annuity and a Roth IRA and it's all tax-free. Well, okay, but you have to, you paid a lot of taxes up front to the government and trust, to become an IRA, to convert your IRA to a Roth IRA, and then hopefully they don't change the rules. You are going to pay taxes. We can help you with how to structure things using different accounts, non-IRA, traditional IRA, Roth IRA, so that you can potentially maximize taxes. But at the end of the conversation, every single time, we have to get your CPA or your tax lawyer involved. Period. No exceptions. Agents and advisors, unless they're qualified to do so, CFP, whatever certification they've gotten, they cannot give tax advice legally. We can come up here at 30,000 feet and tell you our recommendation, but at the end, you have to get the checkbox and sign off from the CPA and the tax lawyer. I would encourage you to go to my site at theannuityman.com. You can download my books for free. You can run quotes 24/7, 365, get live MYGA feeds, see the latest videos and live events and all the stuff that we do to educate and edutain everyone out there. You can actually even email me, stan@theannuityman.com, and I will respond. But do me one last favor. Above my head, spinning clock, there's a video that I did that's called Why People Still Hate Annuities. And it's a question that everyone asks, even in the industry. Why do people still hate annuities? Why do they still hate annuities? I saw something the other day, one of the people from CBS that just got fired for news report. I don't know their name. I don't know their names. So I can't believe people think that we're biased or we have a leaning. Hello? I'm in the annuity business. I'm the leader out here. I'm the number one agent in the country. I understand why people hate annuities. I do. That video explains it, and it's a lot of fun. Hey, my name is Stan, the Annuity Man. See you next time.